Good afternoon and welcome to our annual Economic Forecast Luncheon. It's great to see such a big crowd here this morning. Thanks so much for coming out. I knew there was a reason that we hold this event over lunch this time of year, and that reason dawned on me this morning, and I was very grateful this wasn't one of our normal 7:30 a.m. chamber breakfasts. So I think that helped contribute to such a strong turnout this morning that we all had time to dig out, get the roads dried out a little bit. But it's great to see you all here and have such a great turnout. We have such a strong response to this event each year as we start a new year thinking about where the economy is headed and what that can mean for your business. And that's really what this morning's program is all about, or this afternoon's program is all about, is to share with you some insights and ideas about the year ahead and provide some information that you can use and bring back to your business in mapping out hiring decisions, expansion decisions, new programs, and so we'll have a chance to get into a lot of that, and we have a great speaker this morning who I'll be introducing in a moment to help kick off that discussion. So a few announcements before we get going. I wanted to recognize our board members from the Chamber Board Directors that are here this morning. We have a great turnout from our board. And as I do at all our events, I'd like to introduce our board members so that you can connect with them if you have questions about the Chamber, wondering how to get more involved, or wondering about some of the Chamber's strategic goals and initiatives and things we're doing to enhance the business climate as part of our mission here at the Chamber. So joining us from the Chamber Board today, we have Tom Blonsky from Catholic Charities New Hampshire, Matt Cookson from Cookson Communications, Dylan Cruz from TF Moran, Diane Fitzpatrick from the Boys and Girls Club of Manchester, Preston Hunter from Ekman Construction, who is our new chairman of the Board of Directors, Tom Malafront from Manchester Boston Regional Airport, Tony Matos from Altos, Janella McDonald from Stibler Associates, Kim Roy from the Doubletree, Dick Samuels from McLean Middleton, Anna Thomas from the Manchester Health Department, Mike Harrington from Harrington & Company, and John Sparkman from Divine Milmet. Thanks to our board for being here this morning. So as with all of our programs, we rely on sponsors and our member partners to help us put on programming like this and invest in the Chamber. And I want to thank Whitfleet Howe Riley Howe as our presenting sponsor today. It was a great opportunity to work with them, particularly as Whitfleet is a new member of our business community and partnering with Howe Riley Howe. So I'd like to welcome Allison Perella of Whitfleet Howe Riley Howe up to say a few words. Allison joined the firm in January 2013 as a principal, and prior to joining Whitfleet Howe Riley Howe, she practiced accounting as a sole practitioner for over 2 decades and has been a practicing CPA for 25 years. Allison, welcome.
Thank you, Mike. I really appreciate you saying 2 decades as opposed to something that sounds a lot bigger. And also, thank you for the correct pronunciation of Whitfleet. So I want you to all take a moment to say it. It's Whitfleet. When you read it, W-I-P-F-L-I, it doesn't always sound the way it looks, but that is the correct spelling and pronunciation. But thank you for the introduction and opportunity for Whitfleet Howe Riley and Howe to sponsor this outstanding event. We look forward to hearing perspective on the economy by Catherine Putney, which will help us all plan for this year. You do have a little material on the table. Please take a moment to take a look at it if you're interested later on. As many of you know, for many years, Howe Riley & Howe has worked with New Hampshire's businesses and individuals to help navigate economic and tax changes. Today, as we learn more about this region's economic outlook, the firm's leadership and I are very positive about the year ahead and our firm's outlook, including the additional value we now are able to offer businesses, families, and individuals due to the recent changes at our firm. For those who haven't heard the news, on January 1, Howe Riley & Howe joined Whitfleet a firm with shared commitment to quality, culture, and client service, and one of the top 20 accounting and consulting firms in the country. Our firm's partners and staff are excited about the value it will bring our clients. The combination will allow us to expand the range of services offered to New Hampshire's businesses and individuals beyond the traditional audit and tax services, including things such as succession planning, cybersecurity, process improvement, forensic accounting, litigation, and transaction support. In addition, we now have the help of more than 2,200 associates and 45 offices, including 2 in Maine and 2 in New Hampshire. The additional depth and wealth of experience will help us enhance our ability to serve our customers. In 2019, we look forward to building on our local roots and continuing to work with clients and the business community to ensure success for everyone. Thank you very much.
Thank you, Allison, and thanks again to Whitflea, Howe, Riley Howe for their support. Look forward to partnering with you guys many more times down the road. So before we dive in, just a quick explanation on format. In a moment, I'm going to introduce our speaker, Catherine Putney from ITR Economics. She's going to present for about 20, 25 minutes or so and has some data, some slides, some really interesting trends to share. Then after that, we're going to dive into Q&A and an opportunity to hear from you. So Catherine and I will be over here. We have a loose microphone in the crowd. If you have a question, I have a bunch of questions prepared as well. But just raise your hand. We'll try to get to as many as possible. So it's my pleasure to welcome back Catherine Putney from ITR Economics to this event. She spoke last year, and we really appreciated and found that discussion very interesting. Catherine specializes in applied research regarding business cycle trend analysis, growth cycle trend analysis, and the utilization of cyclical analysis at the business level. And I'm quite sure I have no idea what any of that means. But I think the most impressive thing, Catherine is born and raised from Manchester. She has her undergraduate and master's degree in economics, both from the University of New Hampshire. So she's got the triple crown of homegrown talent, which is great, and having her work here in this business community and talk to the Manchester Chamber kind of comes full circle. So please join me in welcoming Catherine Putney of ITR Economics.
All right, thanks, Mike. Who's excited to talk about economics for the next half an hour, huh? I'll ask the staff to turn the thermostat down so we can get a little bit of a chill in the room to keep people awake after their lunch. But in reality, we will talk a lot about economics today. We'll start very macroeconomic, then we'll hop into some vertical markets and what it means for you, right? It doesn't matter about the data that I'm providing you. What matters is the information that you can take back to your business and implement, right? I can dump this data on you all day, every day. It's about how you utilize the information. So I'm really trying to make that pertinent for your business to go back to your everyday day-to-day job and make it relevant and try to come out on top of your competitors, right? So the road ahead, what's to come? The first kind of 50,000-foot overview is the macroeconomic outlook. What's the largest barometer of macroeconomic activity in the United States? It's GDP, right? So when we look at GDP per nation in the overall globe, the US is the largest economy. There's a lot of individuals that think that China is number one. The US is number one in terms of when you're looking at GDP performance. We are almost a quarter of overall global GDP. China follows suit. And a lot of people think that in the next couple of years, China will follow suit. That's just not the case. We have a lot of competitive advantages in the US to keep us number one. We have near sourcing. We have our population growth compared to China or Japan, right? Last year, the sales of Japan diapers surpassed the sales of adult diapers, of baby diapers in Japan. So they're not dealing with a great population there to keep their population strong, such as the US. And I'm not saying the US is in a great position, but it's in a better position relative to some other nations. And that'll lead us into 2030, where 2019 we will expect a downturn, but I will talk about the fact that ITR does mention that 2030 will be a pretty, I don't want to say apocalyptic, but another Great Depression in the United States. And I'll get to those reasons as we head through today's conversation. Hi. Sorry to stir the room and start off with a negative bias. There are ways to come out on top. I'll show you them. Don't you worry. All right. Let's start off with GDP. Let's look at the more short term before I get into some of that pessimistic stuff. So let's talk about GDP, right? You'll see this chart quite a bit throughout today's presentation. The left-hand side is looking at historical GDP performance through time. That's that dark blue. The teal is our forecast for GDP through time. So when I talk about GDP, I'm talking about the consumer, because GDP is 67% personal consumption. That means if your business is tied to the consumer, you're probably moving with trends in this particular metric that we're tracking. Now, in a second, I'll get to some more manufacturing, oil and gas metrics. If you move with that type of business, if that's what your business is tied to, you'll move to some other things. But in this case, what we're looking at is GDP. What you can see is the right-hand side is the business cycle performance, the growth rates for GDP, as well as our forecast heading out 3 years. What you can see is both the left and the right-hand side are doing excellent. They're doing great. They're both in rising trends. They're doing amazing. So if you move well with the consumer economy, you should be feeling great right now. But this is not going to last forever. We're starting to see some of those signs that this is heading into the backside of the business cycle, that we are starting to see some signs of a slowdown in the economy. And I'll get to some of those trends of why we're expecting that. So we are on the peak. So even though you're feeling good and feeling great, if you're moving with this metric, that doesn't mean you should be going out and hiring new workers, going out and investing in new capital equipment, because this is not going to last forever. So this is actually not the best time to go do that, because a year from now, we're going to be feeling down. We're going to be feeling a little bit of a slowdown in the economy. That's when you want to pull back on hiring new workers. That's when you want to pull back on new capital equipment. So it's very important to know that this period of prosperity that we're going through right now is just not going to be forever. Linear budgeting is not a sane type of thinking. You have to know that this business cycle is going up and down, and we are about to head into that downturn, right? So a lot of trends also that we look at is migration, and that maybe you don't relate overall to the US, but we have to look at regions in terms of migration patterns. So when we look at migration, are people moving to and from each particular state? The states that are more in the blue mean people are moving more towards those states. The states in the more salmon or orange color areas means people are moving out of those states. Meaning from a marketing or a sales standpoint, you want to target those bluer states. That means people are moving toward those states. There's more consumers to be involved with. There's more opportunity for your business in those blue colored states, right? So New Hampshire and Maine, those are in the light blue, so that's, we can probably count on our one hand how many people, and we know them by name, who are going to those states, compared to, let's say, Texas. But Texas is very business friendly, and that's why people are moving there. California, cost of living is so high, and it's very not friendly to business environments. People are moving out of Texas, or out of California, I'm sorry, into those bluer states on the horizon. You can also see, I believe it's New York as well in the negative. That's the cost of living is driving people out. So it's also very important for you to be cognizant that these areas are very important to be aware of. That those bluer states are going to be organically natural opportunities for your business to tackle compared to those more orange or salmon color states, where the opportunities may not be as robust just because people are leaving, and that's going to be a smaller consumer base for you to try to take advantage of. All right. So you heard me mention earlier that your business may not move with the consumer economy. If you're in depth, or if you're talking about manufacturing, mining, utilities, anything commodities related, you probably move better with our other macroeconomic barometer of the US, which is US industrial production. That's largely manufacturing. The other two pieces of that pie are mining and utilities. They move very similar to US GDP, but you can see the swings on both the left and the right-hand side are much more severe. We're dealing with a smaller series here. We're dealing with a series that it's much easier to move the needle on an anthill than it is to move a needle on GDP, which is a mountain. So we're seeing that 2015 with the oil and gas crash, that had a much deeper impact on the rate of change on the business cycle on the right-hand side there for US industrial production compared to GDP. So as we head into 2019, if you're tied to this particular sector, manufacturing, mining, utilities, that means that your business will probably feel a little bit more severe or more hard of a downturn compared to if you're tied to the consumer. Because as you'll notice is on the right-hand side, that forecast, the light teal bars there for our GDP or our industrial production outlook, that goes below that zero line. Our GDP outlook did not do the same. So we do expect that the industrial economy will feel more of a burden as we head into the next year, but do know that both sides of the economy, it will still be the mildest over the course of the past 3 recessions, right? So we looked at early 2000s was technology related, 08, 09 housing, 15 and 16 was oil and gas. As we head into late 2019, early 2020, it's gonna be more tied to a kind of a weakening consumer. So it's not gonna have much of a pull down compared to the past 3 recessions, but know it's coming, know that your audience or your clients will become more price sensitive as we head into that downturn, and start conforming or being malleable in your sales and your marketing tactics towards a more price-sensitive consumer. Whereas last year, people had the cash on hand. Businesses had the cash and they were feeling good, they were feeling great, they didn't care about money. Now is a time that's very different where they're starting to feel a little pinched on that cash. All right, so what are some of the indicators that are telling us that we're going to go into this downturn, right? So this is U.S. industrial production through time, as well as our forecasts on a business cycle basis. We have leading indicators that tell us where our economy is going to head. So when we look at this particular metric, which serves as a good macroeconomic barometer, what we're seeing is what it's about to pop up are these charts, are there leading indicators that are already shifted to the right. So these indicators are already accommodating for the lead time relationship they have to the macroeconomy to give us predictive insight for where the economy is going to head. So the first one is the G7 indicator. Again, already shifted to the right, so you can see that the hard data point, the hard line in that pink line, goes further to the right than the dark line of US industrial production. This is one indicator that tells us we are in a business cycle decline, or we are heading into a business cycle decline. We're seeing also the US Purchasing Managers Index. This is one of my personal favorites. It correlates extremely well to the macroeconomy, and it gives us 9 to 12 months of predictive insight for where the economy is going to head into the future. This took a recent plummet. So we're seeing that sharp decline in that green line as well. On top of that, we have the Wilshire market cap. That's the stock market related indicator. I have some more information later on about the stock market, but this also goes into that business cycle decline. And then the JP Morgan indicator, which is kind of a manufacturing global metric that we track in the US or globally, that is also in decline. And these are all already shifted to the right. So this shows us that we have 9 to 12 months of predictive evidence that that dark blue line, US industrial production, will head into decline in the near future. So be prepared that the US will encounter a slowdown. Math's also in our favor. It's going to be very difficult to keep this blue line into rise, rise, rise forever because of the sheer size of the US economy. So every economy, every market, every business moves in a cycle. The US is at its time where it's heading into that backside of the cycle. This is the fun one that I like to work in that I didn't show in the earlier chart because we did produce this after we created our forecast for the macroeconomy, but it's that red line there, again, already shifted to the right by 16 months. So that's a lot of predictive insight, and it's inverted, meaning the more people Google the word recession, the more likely it is to happen. So our company moves counter-cyclical with the economy because people like to rely on us during times of recession. So can you all get out your phones and just start Googling the word recession? Because we're going to be doing great then, right? But it's true. It's 16 months. You can see, even back in 08, 09, that's the part where I just get astounded by, where 16 months before the Great Recession, people Googled the word recession at an extreme rate. And that was 16 months before it happened. So it's kind of a self-fulfilling prophecy. Nonetheless, we've seen it start to go on the rise as of recently. really confirming our expectations. It's not something we completely rely on when we forecast, but it is a confirming piece of evidence. Another reason why we expect the economy to go into a mild downturn is kind of flat growth in disposable personal income. So we're seeing some, it's at a decent pace, but if you work in the inflationary pressures that we went through in the past year, after you adjust for the price of, the consumer price index and the producer price index, it's not really going to stabilize the economy or stimulate the economy enough to keep us into that rising trend. So flat growth in disposable personal income is really going to propel us also into that business cycle decline. We also have mild rise in delinquency rates, where yes, they've reached their low and they're rising. They're still below the 10-year average, though. So delinquency rates rising is a cause for concern, but the fact that they're still below that 10-year average lets us know that this downturn will happen, but it will be mild. It will be not something that, it's going to be relatable to 2008 or 2009, even, back in the 29s. What you don't see here that I just kind of want to caution you is I personally think that the automotive industry is an area of concern. We're seeing that particular delinquency rate go above the 10-year average. We're seeing contraction in retail sales in automotive. We're seeing inventory starting to build up. We're seeing lending policies kind of getting extended to the 7-8-year car loans. That is an area of concern for us. So just keep your eye out on that. If you're operating in that type of market, just be a little bit reserved. Keep your eye on what's happening. So let's talk about prices. Well, let's look at commodity prices, right? Almost all but steel are in year-over-year contraction. So if you heard me a year ago, my rhetoric was saying, raise your prices. And that was true a year ago. Now we're getting into the environment where prices are starting to temper, where people are starting to get a little bit less confident about the state of the US economy, the state of the world economy, and that drives demand down. And when demand goes down, prices go down. So that's what we're seeing in commodity prices. And the reason I think steel is the only commodity price that's still in that growth is because of the inorganic wrench that we threw into it because of the tariffs. And that we threw, because of the recent tariffs with China, originally China, now it's the European Union and several other nations involved, you're kind of throwing off the whole organic supply-demand factors that are happening in natural economic forces. Whereas now you're limiting supply in an inorganic way, that's driving up prices, and it's especially happening for steel. But, flashback to a year or so ago, all of those metrics, all of those commodity prices were on that decline on the business cycle basis. So that really corroborates our expectation that we will enter in a downturn, because we like to call, copper. Copper has a doctorate in economics, because copper is so diversely used in so many industries that because it's so diversely used that it leads the economy. It tells us where the overall macroeconomy is going to head, and we've seen that on the decline as well. That's reflective in the consumer and the producer price index. That orange line there is the consumer price index. That's you, me, every day going out shopping. What type of pricing pressures do we feel? The blue line is, as a business leader, what type of pricing pressures do we feel as a business leader? Are my wages rising? Are my input costs rising? So what we can see is recently that blue line has downward passed the orange line. Again, last year that blue line was above the orange line, meaning you got to be raising your prices to really accommodate for the lost profit margin that you're dealing with because your input costs are rising. Now we're not in that territory. Now start to really focus on those products that are going to keep your margins high. Start to conform your marketing and your sales tactics towards an environment of an economic slowdown where people are much more cognizant and reactive to pricing marketing rather than quality marketing, because they're gonna bite more at the bit on price rather than quality. All right, shifting gears kind of a bit, is manufacturing dead and gone? I just kind of want to dispel this myth that the manufacturing in the U.S. is going away and it's disappearing. It's not. What you can see here is this is manufacturing production through time from very early on to where we are today. And you can see the shaded areas are times of economic recession. So you'll see that we're pretty much in an ascent. in our overall production. So those dark, even, there's little dips in those gray areas there. Even 1994, that's when NAFTA was put into place, which I was alive for, by the way. You don't have to worry about that. But we're overall in a general rising trend in overall production. So what is this rhetoric? What is this talk in the media that suggests manufacturing in the US is going away? It's the employment in manufacturing. It's the rising wages that are encouraging manufacturing workers to go out and replace human labor with automation. That's what's going away. It's not actual manufacturing, because at the end of the day, we have the competitive advantage to keep the forefront of manufacturing in the United States. We have the nearshoring. We have the technology. We have our low energy costs. Our energy costs are half of that in Europe and a third of that in Japan. We have the competitive advantages to keep ourselves at the forefront of the manufacturing competitive in the US. It's the jobs that are going away. It's the employment that's disappearing. All right, here is the pessimistic portion of my conversation today. Prosperity in the age of decline. This is when I talk about 2030. This is something that's been, as of recently, when I go on the road and I speak, this is something that gets a lot of attention, so I did want to work it into today's conversation. It's talking about 2030 and how ITR expects pretty much a drop off a cliff in the terms of our economic performance in 2030. I think I went too far. Sorry about that. And this is a model for the future. So this is looking at the economy in the 1900s. This is not looking at our forecast for the economy. This is looking at what happened in the 1900s, where we saw recessions happen in the 1920s. We do expect that to still happen in the 2020s, but it's the time when it comes to 30s, so 1930, when the Great Depression happened, is going to be similar to what we're going to go through in the 2030s. And so what are the drivers to that? One is, well, there's many different factors. It's medical cost inflation, inflation in general, demographics. There are 10,000 baby boomers a day retiring from now until 2030. Can you imagine all at 2030, when pretty much all of those are in the Social Security era, the retirement era, where they're going to be requiring this medical attention, requiring Social Security payments, which may or may not be there at the time, is going to be critical. So what I want you to take away from this slide is looking at the delta, looking at the deviation from current tax receipts to the transfer payments. And I know a lot of people do not think that Social Security is considered a transfer payment because you're paying into it, but in this type of chart, we are considering Social Security as a transfer payment. So that deviation, we can on Capitol Hill, we can argue all we want about, NASA, about all of these consumption expenditures, infrastructure. That's the bottom chart there. That's not going to move the needle on our debt ratio. We're at 125% debt per GDP right now. That's not going to help if we're not making changes to that top line there. And that's political suicide, right? So this is 10 years in the future now where we're expecting this downturn to happen. What politician is going to advocate for higher taxes now to save our butts 10 years from now when they're worrying, a year or two in the future of how they're going to get reelected? So this is something that the US economy is very reactive instead of proactive and with their economic position, that if we don't make changes in the next couple of years, this downturn, I don't want to say apocalyptic recession or depression, but it's going to be severe in 2030. So it's all about how you take advantage of it in the next 10 years to really come out on top. Buy low, sell high. That's when people make their money. Really prepare yourself for the recession that's about to come in the 2030s. Our CEO and president have a great book called Prosperity in the Age of Decline that's available if you'd like to get it. It talks about how you can prepare yourself for the 2030 depression and how to come out on top. So it's something, if you're interested in, it's available. They talk about, getting away from equities, going into Switzerland, Australia, or Canada in terms of bonds, all those types of different things that kind of safe havens to invest in to make money in this 2030 Great Depression. All right, kind of the last part of our conversation today is talking about the stock market. Again, I'm not a financial advisor, so I can't tell you what to invest in or not to invest in, but I do look at data trends. I look at what's going on in the market. Here we have the Morgan Stanley Composite Index. This is basically looking at basically everything other than the US, the equity positions of markets that are not in the US, developing nations. And that, again, that green line is shifted to the right already to accommodate for the lead time relationship it has to the stock market, which as of recently has taken a little decline. So that further decline in that green line really corroborates further decline in the stock market. What we also look at is what we call the CAPE ratio. Some of you may be familiar with this. That purple line is looking at the cyclically adjusted price to earnings ratio, meaning when that purple line is higher, there's a higher inflation of prices to earnings. That there's a bull market going on where there's a lot of high inflation going on the stock market versus the lower part of that purple line, meaning prices are low relative to earnings. This is when I want to go invest low, sell high. Those lines, so the red, yellow, green lines indicate if you were to invest at that point in time, when that purple line met that particular line, I would make X amount of investment return over a 5-year period. You can see the 5-year return is just over 2%. The bottom line there, the green line, is over 12%. So that really goes hand in hand with buy low, sell high. But if you look at where we are today, we're hovering at that red line, meaning people are starting to take out of the equities market and head into the bond market. And that's why we've seen the bond yield go down recently, because bond yields and prices are inversely related, so that yields are going down, that means prices are going up because there's higher demand for bonds. So we're seeing that happen in the market nowadays, meaning people do have the skepticism, people do have the lesser confidence in the economy right now that we're going to continue this hot train all the way into later this year and into 2020. And we're seeing it develop in the data that we're looking at. So our outlook for interest rates, and whoever was here last year has already seen this chart, but we've updated it for today's Fed chairman, and our forecast is 100% driven by the height of the Federal Reserve chairman at the time, right? So we do expect that interest rates will continue to rise, maybe at a modest pace, but if I'm next, that's when you want to go and invest, because it's going to be a lower rate when I'm the next Fed chairman. Nonetheless, they have had a more relaxed position for 2019 because of the higher inflation that we've seen. They pulled back the reins a little bit on their expectations for interest rate rise in 2019. Nonetheless, we do not expect them to decline still. So know if you're going out there trying to buy that house accommodated with inflation, the natural inflationary trends such as 2.1%, 2%, now is going to be the best time, because even next year we don't expect interest rates to decline at all. We offer a free 90-day trial for our Trends Report. It's basically a monthly subscription to a magazine that has many different markets. It has construction, manufacturing, stock market, global markets. So if you're interested, you can subscribe get a free 90-day trial by texting that TR trial to that number, and you'll be signed up to get that free 90 days. That's all from me. I hope I didn't go over too much, but that's all I got from me for the economy today. So looking forward to your questions.
Okay, we've got a good amount of time for Q&A and discussions. I think we teed up a lot of interesting items. So if you do have a question, I have a few I'm going to start off with, but just raise your hand, catch my eye, and I'll be sure to recognize you. And I think we have a mic in the audience, so that one should be good to go. Catherine, I want to start with kind of the top line message. It sounds like one of your central piece of advice is that the economy is always in a cycle. It's going up, it's going down, it repeats. But a business should act accordingly. And so have the knowledge of where we are in that cycle, and then tailor your actions, your budgeting, your strategic decisions, to that. And so it sounds like right now you feel as though we're heading into the backside of a down cycle. We're heading into a down cycle. We're on the backside of the business cycle. And what's your level of confidence for 2019 for a business owner? How far into that downshifting are we headed? Are we in right now? Will we be going into? And put yourself in the shoes of a business owner and how they would treat some of those big decisions in 2019.
Yeah, it's for me, it's all about recognizing, one, what you do as a business, right? So if you're tied to the consumer, you're looking at very different metrics. You should probably be looking at GDP or some other type of metric that relates to the consumer. And what's more important is how you relate to GDP, because you may not move hand in hand with the same timeline as GDP. You could lag it. You could lead it. If you're, there's construction's typically a lagging indicator. If you're in the construction market, you may be feeling greater in 2019 than you were in 2018 because 2018 was an excellent year for the economy, meaning construction in 2019 is going to be a great year because construction typically lags. So it's all about understanding your position in the economy and how you relate, not just where GDP is today, where employment is today. It's all about understanding the relationship you have to the economy and utilizing that information, because we will head through a slowdown in 2019. And many businesses look at, we look at 2019 as a slowdown, but if you're only looking at your data on a yearly perspective or a quarterly perspective, you could still see positive growth. Positive growth does not mean acceleration. Positive growth could mean a slowdown. So it's important to track your rates of change, to track your numbers every single month to know, are my numbers slowing? Because when you only look at positive numbers, you could mislead yourself and say, I'm going to go hire new workers because I'm still in positive growth. But the leading indicators in the system might say, you're going to be heading into recession in the next couple of months. This is a time now when you're still feeling positive, when you want to have, build up the cash. This is when you want to have some of your cash built up. This is when you want to start diversifying your training to make sure that your employees can be well diversified in the training in case you have to let go of someone, they can handle that. This is when you want to be more reserved. Even though you're still technically feeling good, you want to be cautionary in the slowdown in 2019 compared to, let's say, last year where we're feeling good, we're feeling great. This is when you want to basically make sure that your capacity can handle what's coming at you.
So I want to touch on something else that, at a risk of reading the room, it sounds like apocalypse got everyone's attention a little bit. I think it's a great thing to bring up, but and obviously you put it in stark terms, it gets people's attention. But the idea of debt and deficit and entitlement spending eventually, coming home to roost is not a new idea, and some politicians have staked entire campaigns on that idea, none successful. But I guess what you guys are putting out there is you think there's a date certain, 2030, when that really does come home to roost, and we'll start to see the impact of not addressing some of those structural issues. Could you explain a little bit more about what is it about, why 2030? And is it purely a numbers game of the number of people who are retiring and entering the system that'll start to tax those entitlement programs?
Yeah, it's not gonna be one sole driver or catalyst to this downturn. It's gonna be the straw on the camel's back. It's gonna be the accumulation of inflation, medical care costs, all of those types of things, such as Social Security, which there are easy fixes to Social Security. If you raise the percentage contributed by employer-employee to 15% from the, I think, 12.6% now, 30 extra years of Social Security. If you remove the cap, which is just over $200,000, or over, I believe it's $200,000 of what can be taxed for Social Security, another 30 years. There are ways to fix it. It's just, as of right now, it's not going to happen.
Are there any presidential candidates in the room today?
Yeah.
Usually that's, I have a pretty good shot. If
there are fixes to it. Our CEO and president say, let's just start a war in Florida involving old people, and then we'll just go on. It's called the pillow effect, right? You just take the pillow and... That's not from me. That's from my president. So don't quote me. Don't get mad at me for that.
I don't know what chapter of the book that gets to. Yeah. So something to watch, but essentially what you're saying though is that there needs to these types it has to be structural changes to these programs to address them. This is not something that can be slightly adjusted. These are structural changes that require kind of foundational changes to these programs, whether it's the contribution rate, whether it's the amount that's taxed, or the age threshold, or something along those lines. That's what you think policymakers have to do if they're genuinely going to address this.
Yeah, absolutely. And there comes a time where it's going to be irreversible, right? So you can't wait to the year before, 2 years, 3 years, 4 years before it's going to happen, where it's inevitable. If we don't make changes in the next couple of years, this is something that can be pretty much. I mean, I'm not sure if any of you have seen Armageddon with Bruce Willis, where that crater is coming to Earth.
Not the best comparison, probably, but I get where you're going. Right?
It's a metaphor. It's a metaphor. But basically, once it crosses a certain threshold, there's no turning back, and it's like that, where it still hasn't hit Earth yet. But if it crosses beyond that threshold, there's no turning back. And we're coming across the years where if we get to a certain point, it's not going to be irreversible. Where we're going to enter in the next couple of years. So we got to make changes now and soon, or else this thing is going to happen. And it's very unlikely that there's going to be politicians advocating for higher taxes with no benefit in the next 5 years. So
we're all well equipped for, as you bump into presidential candidates on every street corner over the next 12 months. Maybe this is the first question you can ask them if they have a plan on this particular issue. Another kind of item that's, I think, particularly interesting right now, given all that's happening in Washington and over the past few years, talking about is you talked about China and our economic relationship with China, and we've had some extra attention on that recently because of tariffs and talk of a trade war. But I thought it was interesting that you said despite the discussion around that, we have some inherent advantages still that despite the rise of China's economy over the past several decades, we're still in good position. My question is, what are some mistakes we could make? What are some things that we could do that would erase those advantages? And is one of them a protracted trade war where we're heaping tariffs on each other, going back and forth? That seems to be what some are arguing is the potential risk, that while we're trying to bring better balance to our trade relationship with China, we could actually trigger a prolonged negative effect by getting into this type of protracted trade war.
Yeah, I completely agree with you that trade wars don't help either sides. That you're limiting specialization. We're all for specialization. Where if China's better at doing something, let them do it. It makes them be better at what they're doing and lets us focus on what we're doing better as well. But when you introduce this trade war, when you introduce the reactions that we're doing because of, let's say, subsidies, that China's subsidizing their steel industry, and that they're dumping steel into the U.S. at unfair costs, we're reacting by putting these tariffs into place. That is, again, as I mentioned earlier, that's throwing a wrench into an organic supply-demand chain that's creating inflation. So at the end of the day, U.S.'s profits are eating away. China's profits are eating away because we typically make sorts of deals that say, I'll eat 50% of the tariff, you eat 50% of the tariff. So at the end of the day, it's still creating inflation in an inorganic way. And on top of that, it's hurting the U.S. It's hurting the U.S., but it's hurting China even more because, one, China's a very prideful nation. They will sacrifice longer and harder for their economy because because of their pride. U.S. is not the case. But also, China is also more dependent on their exports than the U.S. is. China's exports are 3.4% of their GDP. U.S.'s exports are 0.7% of its GDP. So they're being hurt more, but it's whether or not they're willing to suffer longer But in both cases, we're both suffering. It's just about who's willing to suffer longer. China has their pride, but China also has the fact that they're suffering more because they're more reliant on export activity compared to the U.S.
So we have a few more minutes. I have a couple more questions, but again, if there's any questions from the audience anyone would like to throw out there, just shoot up a hand and I will recognize you. Yeah, we have a question over in the back. If you could just wait a second, Jocelyn's on her way over with a microphone.
You had the question? Oh, perfect. Sorry, excuse me.
Catherine, thank you for your presentation. I think the overall tone of what you shared today was a little daunting, right? But so important for us to hear. What spoke to me really loudly was opportunity. So I wanted to see if you agreed. I wrote down a couple bullet points. My name is Jeremy Lindquist. I own Sky Peak Financial just up on West Webster, just up the street. And we think about these things regularly. So it seems like, as business owners and members of this community that are running businesses, that it's an opportunity in the next few years for us to highlight our differentiators and pull our vendors and our partners close and share this information so that we can be prepared. It seems like we could capture some market share by being the ones that think about this now in Manchester and in our communities, right? I think that the money supply is strong, and there's great opportunities to sell businesses on an uptick and potentially consider our exit strategy if we haven't. So I think those are all the positives that kind of seem to be the countervailing ideas to the macro picture. It represents opportunity. Movement in the marketplace, movement in the economy says, take those steps, think of those things while you're sitting back and enjoying the high rise of your business. And I just want to see what your thoughts are on that.
Absolutely. This is when you want to take advantage of what's happening in the economy, because most businesses, similar to the U.S., are reactive rather than proactive. If you know the signs that's happening early on, this is when you want to build up your cash. People are feeling good. People are feeling great. I have a great example from a client that has worked with ITR for years and longer than I've been there in 08, 09 during the Great Recession. That our team told them that this downturn was happening. They built up their cash reserve during that time, and during the depths of hell, pretty much, they ended up buying a piece of manufacturing equipment that was valued at $800,000. They bought it for cash at auction because everyone was down in the dumps at that time. They bought it for a quarter of the price, $200,000. And even though they didn't need it at the time, they knew what was happening. They knew the downturn was coming. They prepared themselves by building up the cash to weather the storm. And they made out, even though they didn't need the piece of equipment for their company for 3 years or 2 years, when they utilized it, they bought it for pennies on the dollar. So that's what you really need to be cognizant of, is what's to come, knowing what's happening in the economy, knowing how to prepare yourself for what's to come, because we are going through a downturn, and many businesses won't recognize it, that they won't see it coming because it is going to be a mild downturn, but it's still going to happen, and they're only seeing positive growth. GDP is still going to grow year over year as we head through the next downturn, but it's going to be at a slowing pace. So you still want to implement the strategies in this slowing environment, such as building up cash, such as focusing more on your more profitable segments of your business, because that's going to keep, even though it might not keep your top line happy, it'll keep your bottom line happy.
Another question I wanted to touch on was you mentioned automotive was a sector that you're concerned about and seeing potentially a bit of a dip downturn there. Are there maybe just a bit more on what's driving that? If there are other sectors that you're concerned about, and the inverse of that, are there some sectors that through this next segment of the cycle are you seeing promise in? Are you excited about? Do you think there's any really explosive growth sectors that we're seeing that could outpace the rest of the economy?
Well, there's always going to be sectors of the economy that move counter-cyclical. So security, such as that one, where the economy goes down, people start stealing. So security goes up, so that's an industry that's an area of opportunity. In terms of automotive, we're seeing a lot of stray away from the US and Canada into Mexico. So Mexico is actually doing quite well in their automotive industry, and it's going away from the US because of the cost of labor, because of the cost of automation, and recent legislation policies that are driving we saw it with GM recently, moving their plants out of the U.S. into Mexico. So that's an area that I'm seeing some risk. But if you're in Mexico, seeing that opportunity in terms of the automotive industry. One industry that we expect to be opportunistic is food. And I want to caveat that, though, with the food industry, yes, is not expected to go into a recession. So if you're involved in food production, food manufacturing, any types of food manufacturing activity or production, it will not go through a downturn. However, margins in that industry, I've found with discussions with my clients that it's razor-thin margins. So the opportunities will still be there, it's just margins may be slim. So top line may be good, bottom line may be still scraping by. But that's an industry that we do expect to avoid recession. An industry that's doomed is probably paper, paper industry, the shift towards e-commerce. Again, that's a discussion I'd be happy to talk about too, is e-commerce. You have to be making sure that your website is up to date for iPhones, for just attractive and a friendly relationship with your online consumers, because people spend a whole lot of time researching on their phones, spending on their phones, doing all the research first before they spend and go and contact your business for new opportunities. So really honing in on your website is going to be something that's going to keep you on top of your competitors as well.
Another interesting tidbit that you brought up that we talk about a lot when it comes to workforce development was your slide on net migration by state. And I think we got a little bit of good news there that New Hampshire was kind of amongst itself, along with Maine in the Northeast, of being just a nice light hue of blue. We'd like to make that darker. And so we did get some news recently that we had some modest net in-migration, and in particular among younger people, among 20 to 40, which there's been a lot of emphasis and efforts put behind. What the states that are dark blue, where I think you had highlighted cost of living, the business climate as being kind of the driving factors.
Dark maroon, you mean?
What's that?
The dark maroon?
Yes.
Yeah.
No, excuse me.
Dark blue are people moving to.
The ones that people are moving to,
Yeah.
what are they doing really well? And I think what you had hit on was the business friendliness of a state like Texas is one that's driving it. Are there others that, other factors that you think those states that are growing have really hit upon? What policies are they really contributing to that? Obviously, demographics is a bigger issue.
Marijuana.
That we can't.
Colorado and Washington
Colorado
are
was
in
very
the positive.
dark blue. Yeah.
Yeah, there's a lot of millennials moving to the Northwest because of the new job opportunities, tech, Amazon's out there, Starbucks, all of those types of areas are really moving millennials out to the Northwest regions, same as Colorado, as well as the huge influx of millennials to that area because of recreation, not only marijuana, but skiing and all of the amusement side of things. Southeast is mostly positive because of the baby boomers. Whereas, you retire, you typically move to warmer climates, and that's why we're seeing those southeast regions in the more positive. Texas is positive because of its very friendly business environment, because of taxes, because of the way that the state treats their employees. And I say that counter to California, whereas California was more on the negative side for their business because California's state regulates businesses to treat their employees in a certain way that's in favor of the employees, but not in favor of the employers. So employers did not like the way that they had to treat their employees, whether it be salary or hourly, that it forced businesses out of the region, and that's why you saw more of the blue states surrounding California, because businesses were leaving because they didn't like the way that they, one, the cost of living, and two, the way that they had to treat their employees. So that drove businesses out, and that's driving people out to follow because people typically follow suit of where the jobs are.
So to wrap up, I think maybe just a summation of, you teed up a lot of interesting issues, and particularly some decisions that we have to make a business community, but also policymakers. And I think that's, as a chamber, we're always interested in that issue of what can we encourage our local or state policymakers, our federal policymakers. Aside from addressing the 2030 cliff and the entitlement spending in that piece, if you were asked by a policymaker, a governor, or a member of the federal delegation or even a state legislator about where should they focus their efforts on changing policy if they want to support and enhance the economy? What area would you steer them towards? There's lots of specifics we could get into, but generally, where do you think policymakers can get the most bang for their buck when it comes to making changes that spurs economic growth or supports economic growth?
I don't think there is an answer for that. I think that, if we want to save our butts in the long run, there's going to be sacrifices that need to be made, because if there was a fix-all easy option, then every policymaker would be advocating for that. So the kind of transparency of it is that we're going to have to raise taxes, which is going to limit stimulus on the economy because it's going to limit consumer spending to save our butts in the long run. So there is no easy answer to kind of get us out of what's happening and try to stimulate economic growth in terms of policy. Our biggest fix is we're going to have to raise taxes, which is going to slightly hurt the economy, but in the long run, it's going to make a fix. And that when 2030 does happen, millennials will be the individuals on Capitol Hill at the time. Mm-hmm. And so they will be making the appropriate reactions to policy to get us out of it. And we like to call it kind of it's probably bad timing for this, but an economic forest fire, where we're clearing out all the dead wood, right? So we're clearing out when this apocalyptic downturn happens, we're clearing out all of the dead wood, and it gives the light be able to grab the new economy that's about to head into the 2030s. So there's going to be areas that are going to be new opportunities come the 2030s, unfortunately at the sacrifice of the older generation sacrificing their businesses at the time. But also we're in a time now where we do have the baby boomers, we do have the older generation in the heads of the businesses as the C-suite executives, as the CEO, the CFO, which they're heading into an age where they're becoming more risk averse. They're not going to be as aggressive in their strategies in business because they're worried about their future and their portfolio moving forward. So as we head into a time in the late 20s, when millennials are starting to take over, that's the time when we're going to really sprout. But there isn't an answer for what's the perfect reaction for policy or legislation to make us come out on top.
And just to close, in terms of the cycle and the timing of it, your message last year was we were really heading into the upswing. 2018 was a strong year. 2019, we're entering the down cycle. Where do you think we'll be in 2020? Around this time? Will we have come through that down cycle? Will we still on the back end of it? Or how far off before you think the next up cycle is?
So our current outlook is the first half of 2020 is still going to be hard. It's still going to be a downturn. And then it's the second half of 2020, which is going to see some optimism, but it's not going to be great. It's going to be better than the first half, but it still may not mean year-over-year growth. It's going to mean recovery. So things are still down, but they're not as bad as they were in the first half of 2020. And that's when 2021 happens, and that's when you should be feeling good. But it's also important to be cognizant that you may not move directly with the economy. It's very important to understand your relationship. Do you lead? Do you lag? And that's something we can help you with if you're trying to figure out how you move with the economy, but that's something that is key to understanding how your business should be feeling into the future. Do you move with the economy coincidentally? Do you lag it or do you lead it?
Let's have a round of applause for Catherine. A lot of thought-provoking remarks
Thanks,
this morning.
guys.
So on behalf of the Chamber, I want to again thank Whitfleet Howe Riley Howe for being our presenting sponsor. Thanks so much for your support. I want to thank Events United for being our AV partner this morning, and big thanks to the Puritan Backroom Conference Center for hosting us. We've got a lot happening over the next month or so. If you haven't signed up for our State of the City Forum with Mayor Craig, I would highly recommend doing so soon. That event always sells out, and it will sell out this year. So that's coming up on February 13th at Fratello's. Have a great day, everyone. Thanks for coming out. We'll see you again soon. Thank you.